Hey everyone, and welcome. Today, we are going to tackle a super important part of smart investing for 2026, and that's portfolio rebalancing. You can just think of it as a simple yearly tune-up to make sure your financial engine is running just right and, staying on course. So, let's dive in.
Okay, so let's imagine your portfolio had a great year. I mean, that sounds amazing, right? So what could possibly be the problem? Well, here's the twist. That very success can actually sneak a hidden risk into your investments, and you might not even realize it's happening. Let me show you exactly what I mean.
So look at this. Let's say you started out with a really balanced 60-40 mix of stocks and bonds. That's your target on the left. But then, stocks have an awesome year. Well, after that happens, your portfolio might look more like the pie on the right. Suddenly, it's 75% stocks. This is what we call allocation drift. And the crazy part is, you didn't make a single trade, but your once balanced portfolio has become way riskier than you ever planned for.
So how do we fix this drift? Well, over the next few minutes, we're going to cover exactly that. We'll talk about the hidden risks, I'll give you a simple tune-up checklist for 2026, we'll walk through how to rebalance, and then we'll cover some tools and common mistakes to avoid. By the end of this, you're going to have a really clear, actionable plan.
Okay, first up, let's really dig into this hidden risk. We're going to see why rebalancing is honestly one of your portfolio's best friends. It really is all about staying in control.
So, why does this all matter so much? Well, it really boils down to three huge benefits. Number one, it keeps your risk level right where you want it so you don't accidentally become too aggressive. Two, it forces you to be disciplined, which helps you avoid making emotional decisions when the market gets crazy. And third, it pushes you to check in on things like fees and taxes, which can literally boost the amount of money you actually get to keep.
And, this is especially important right now, in 2026. After a really strong run in the markets from 2023 to 2025, a lot of experts are saying U.S. stocks are fully valued. That's just a fancy way of saying they might not be the bargain they once were. In a market like this, discipline and diversification are absolutely your best friends.
We also have to think about inflation. It's projected to be somewhere in this 2.5 to 3% range. Just think of this number as the hurdle rate. If your investments aren't growing faster than this, then you're actually losing purchasing power. Your money is worth less over time.
At the same time, the Fed is expected to have policy rates somewhere in this range by the end of the year. Now, why does that matter to you? Because it directly impacts what you can earn on the safer parts of your portfolio, like bonds and cash. It just makes your decisions about where to put your money even more critical.
Okay, so how do we actually put all this into practice? Let's get tactical. We're going to walk through our 2026 tune-up checklist, which breaks everything down into a simple routine, from just a quick glance to a full-on review.
Now, the key here is not to make this a full-time job. Don't overdo it. Think of it like this: a quick 15-minute check-in each month, a slightly deeper review that takes maybe 45 minutes each quarter, and then just one big comprehensive tune-up once a year. This makes it a sustainable habit, not some awful chore.
All right, your monthly check-in? Super simple. First, are your automatic contributions going through on schedule? Second, just take a quick peek. Is your main stock and bond mix wildly off, like more than 10%? And finally, are you letting a bunch of cash just pile up instead of putting it to work? That's it. Done.
Okay, every quarter we're going to dig just a little deeper. You'll check for any drifts over 5%, see how your funds are doing compared to their benchmarks, and take a quick look at your fees to make sure they're low. But honestly, the most important part is what I call the sleep at night test. Ask yourself, if the market tanked 20% tomorrow, would I stick with my plan or would I hit the panic button? If the answer is panic, that's a huge sign your mix is probably too aggressive for you.
And finally, we have the annual tune-up. This is where we zoom out. This is where your money strategy meets your real life. Have your goals changed? Maybe you're closer to retirement or planning a big purchase. This is when you look at your entire portfolio, your 401k, your IRA, everything together. And you get smart about taxes, looking for opportunities like tax loss harvesting to potentially lower your tax bill.
All right, so you've done your review and you've found that, yep, your portfolio has drifted. Now for the fun part, actually getting it back on track. And believe me, there are two incredibly simple ways to do it.
You've basically got two main flavors to choose from. First is the threshold method. This just means you rebalance anytime one of your holdings drifts off target by a set amount, say 5 or 10%. The pro here is that you're responding to what the market is actually doing. The other option is the calendar method. It's even simpler. You just pick one day a year, maybe your birthday, and that's when you rebalance. It's foolproof, and it stops you from trading too much.
Now, I want to share a really powerful way to think about this. A lot of people hear rebalancing, and they think it's all about selling their winners. But there's a much less intimidating way to do it. Just use all your new money, your new contributions, to buy more of whatever part of your portfolio is lagging behind. You're basically buying the asset that's on sale.
Okay, this next part is so important if you want to avoid a surprise tax bill. The order you do this in matters a lot. Here's the sequence. First, always use new cash from your contributions or dividends to buy what's underweight. If you still need to do more, make your trades inside your retirement accounts, like an IRA or a 401k, because there are no tax consequences there. Only as a last resort should you ever sell anything in a regular taxable brokerage account.
Now, I know this might sound like a lot of work, but the good news is there are some fantastic and often free tools out there that can do almost all of the heavy lifting for you.
Your own broker, like Vanguard or Fidelity, probably has built-in tools that show you your allocation. They're great, but for a big picture view across all of your different accounts in one place, Empower's free dashboard is an absolute game changer. And hey, if you're a do-it-yourselfer, you can build a perfect custom tracker in a simple Google Sheet.
All right, we're almost at the finish line. But before we wrap up, we have to talk about the pitfalls. Because honestly, knowing what not to do is just as important as knowing what to do.
Let's run through the 4 biggest traps. First, and this is a big one, emotional selling. Panicking and selling when the market drops is the fastest way to guarantee you lose money. Second, chasing performance. Buying last year's hot stock is almost always a losing game. Third, overtrading. Fiddling with your portfolio too often just creates extra costs and taxes for no good reason. And finally, ignoring fees. It sounds small, but even a 1% fee can eat up nearly a third of your returns over a lifetime. You've got to pay attention to them.
So look, doing all this yourself is awesome and it's perfect for most people. But there are definitely times when it just makes sense to call in an expert and get some professional advice. Here's a quick checklist. If you find yourself nodding along to any of these, you might want to consider it. If your portfolio is getting pretty large, or your tax situation is complicated with things like stock options or a business, or if you're navigating a huge life change like retirement or an inheritance, sitting down with a fee-only financial planner can be an incredibly smart move. Okay, so what's the one thing I want you to take away from all this? It's simple. Knowledge is great, but it's action that gets results. So before you click away from this, I want you to do one thing. Open up your calendar right now, pick a date, and schedule your annual financial review. Make it a recurring event. Turning this one simple task into an automatic habit is probably the